Welcome to the 18th episode. We'll jump straight into it. So, Romeo, I'm seeing so much hype around Neobanks recently, and people are calling them almost the perfect launchpad for stablecoins. And do you think neobanks actually have that much potential to disrupt the stablecoin space? I'm curious, like, what do you think about the whole situation?
Yeah, neobanks have existed for the last 10 years in some capacity, offering different financial services in different regions, right? But the space is actually so fragmented, and the definition of a neobank is so scattered that you can't really say
Hmm.
that neobank works, or this is the right neobank infra for crypto. But for the sake of this discussion, let's just assume that any fintech platform that offers some sort of a custodial service is a neobank, right? So where do stablecoins fit in this puzzle? Let me quickly give you a bit of an overview of the market
Hmm.
first before I go deeper into this topic. Now, different market analysis gives you different numbers, but in 2024, some market reports say that neobanks the total market value of neobanks is anywhere between $70 billion and $176 billion. Now,
Hmm.
this difference and this difference in the projection or calculation is because of the fact that what do you consider as neobank, right? You can
Right.
it's basically a broad range of financial technology companies, which now some of them are like brokerage apps like Robinhood, while others can be a bit more narrower in their definition. Either ways, the forecasts have been consistent about the projection that the market is going to reach anywhere between $2 trillion to four to $5 trillion as early as in the next 10 years. So obviously, this market has a lot of potential, and where we are seeing most of this growth is in actually surprisingly is in Europe. Like Europe has historically been the epicenter of neobank revolution in the last I don't know, like 5 years, 5 to 7 years. About 34% of the global revenue share of neobanks come from Europe. Like it came from Europe in 2024. Revolut, N26, Monzo, like all of them have achieved significant scale in Europe. And then we have Asia Pacific regions where neobanks have grown in different versions. Like in India, we have the entire UPI system and the
Right.
neobanking infrastructure that basically sprouted around the UPI system. In Latin America, you have different countries, different neobanking infrastructure. Like for example, Brazil leads the world in terms of neobank adoption with about 43% of its population of basically 43% Brazilian people use one or the other neobank. Now, this one of the biggest neobanks in Brazil right now is Neobank, which serves up I think over 100 million customers across. You have got the Latin American regions, Latin American countries like Brazil, Mexico, Colombia. So yeah, that's staggering, obviously. And the United States has obviously a fair amount of neobanking infrastructure in place, but it's not as large as the other markets that I mentioned. um,
So wait, Europe is the one leading the race. I almost expected like Asia, Africa, or Latin America to be ahead. Like, how's that?
yeah,
Why is
yeah,
that?
right, that's the exact thing that I was thinking about. Like, why is Europe the one leading it? Europe isn't known for any of this sort of like
Right.
innovations and adoptions at such an early stage. Now I think the reason that we are suspecting, or basically we are almost like surprised that why is Europe leading it, is actually quite predictable, in a way that the European banks were so consumed by their traditional and monolithic structures that they didn't really care about going digital in the early 2000s, like every
Hmm.
other countries or every other first world country did, right? So what that means is, even in the early 2010s, European people didn't really have any other option for digital banking outside of other than just going to your bank branch and doing minimal amount of digital features that were available, that were made available by these banks. So what uh, that was a clear gap in the market, and what happened was basically fintech platforms came, they saw the opportunity, and they basically rushed into it and solved it by creating a bunch of neobank platforms. And what really helped that situation is Europe was actually quite fast in issuing clear guidelines and clear regulations in terms of what kind of digital banking infrastructure can work. And thankfully, they were fast enough and they were clear enough that these startups got a head start, and they basically now dominate the European banking infrastructure, right? And that's generally the criticism with Europe, is that with regulation they generally choke the growth of any
Mhm.
industry, so to speak. But in this case, it worked in the opposite way, and it worked out for the better. So yeah, that's basically how the new banking infrastructure of the world right now is working. And yeah, so that's the neobank side of things. And what about the stable coins, right? This podcast is exclusively focused on stable coins, and we have been
Mhm.
discussing this figures episode after episode. Right now, only like since 2018, back in 2018, the total volume of on-chain settlement settled into stable coins was about $3.3 billion. Last year in 2024, the number was at $18.4 trillion. Like this is,
Six
I don't know.
years.
Yeah, in 6 years, I don't know how many 1,000% jump that is. Now obviously $18.4 trillion is not like pure transaction. A lot of it is about like arbitrage trading and DeFi related activities. But even if you uh, even if you like, you look at critically, okay, like it isn't as high as we are saying it is. But at the same time, the transaction is a transaction, and the value of a transaction, any network that can handle $18.4 trillion worth of settlement, is a platform that is robust enough that you can do pretty much anything payment related. When you compare it to, for example, say Visa only settled $15.7 trillion. Mastercard did even less at about $9.8 trillion, right? So stablecoin clearly has the infrastructure to do to surpass Visa and Mastercard, and we are still at a very nascent stage. We are not like, we are nowhere close to the brand recognition that Visa has or Mastercard has, right? So I don't know, like in the next 10 years, this number is probably going to 10x, and we're going to be at around $200 trillion. Uh,
Mhm.
that's the trajectory that we are looking at, right? Now, the the point that I want to mention here is how stable coins, and not specifically stable coins, how neobanks can merge with stable coins to help in different economies, to serve different purpose in different economies.
Mhm.
So we have got the emerging economies, and we have got developed economies. The two economies obviously interact differently when you introduce this combination of neobank and stable coins. And here's how it does it in the emerging economy. Like, for example, in a country like Argentina, Nigeria, or Venezuela, or even Turkey, the primary concern regarding currency is going to be inflation. Like, if your country is losing the value of it,
Right.
if you're losing 40% of the value of your money in a single year, that then obviously you want something that can hold the value of your savings. For example, dollar. Now, how can you access dollars? You don't have the traditional infrastructure to save in dollars, to invest in dollars, etc., etc. That's where neobanks can come in. They can offer stablecoin solutions, and through a neobank you are saving in dollars. So that's obviously, you have got your inflation hedge, right? And then the other thing is remittance and cross-border payments. You work in a different country, you want to send dollars to your home, but if you do it through the Swift method, uh, the bank that receives that dollar is going to convert it into the local currency, give you the local currency, or keep the dollars for themselves. There is no way that they're giving you access to dollar directly, right? So that again, so what happens is you use a platform which is a neobank that's offering you the option to send money in stablecoins and receive money in USD dominated stablecoins, right? So that's how neobanks and stablecoins can help in the emerging economy. And then you've got developed economies. Developed economy means you already have a strong enough currency that you are not afraid of 40% inflation,
Right.
where at best you are looking at like 3 to 5% inflation yearly. So, and you are not really like, you already live in a developed country. You are like the citizen of a tier one, or how you say it, first world country. You don't you are not a migrant worker. So cross border remittance is not going to be as major an issue to you
Right.
will be to a migrant worker. So what your primary focus or your primary priorities in this economy will be is programmability and automation. So like stablecoin is obviously programmable money, right? It's embedded into smart contract, and it helps you automate complex financial agreements and
Mhm.
workflows. So what you want to see is something like 24/7 to 24/7 and 365 days instant payment settlement. You want to move large amounts of money from point A to point B without really going through an interrogatory a period where people ask you, like this banks will ask you different information, like who are you
Right.
sending money to, why this amount of money, give us some proof, etc., etc. Or you may want something like higher yields. If your savings account in the first world country is not giving you more than like 1 or 2% yield, I mean even 2% is a stretch. I think it's a 1% or less than 1%. So and if you want higher yield, you have to lock your money into some sort of a fixed deposit scheme of some sort. Uh, but in a stablecoin environment, you don't necessarily have to do that. You can access to much higher yield without locking your money at all. So
Now, given the difference between the two economies, do you think that emerging countries will see higher retail adoption, whereas the developed countries will focus on onboarding like institutions?
yeah, I mean that's where it's going exactly. As I said, because the solution, the problem that you are solving in the emerging markets is going to be specifically about
Right.
it's going to be the retail's problem. Retail wants the average person wants a solution that helps them with inflation. The average person wants to send dollar back home, right? So but again, like in an advanced developed world economy, those problems are easily solved. So what you want at that point is you want to be able to create some sort of system that is capable of settling trillions of dollars in near instant time, so that all of the institutions that you have that are managing trillions of dollars can have a much better and much more efficient infrastructure, instead of relying on something that takes sometimes days to settle transactions, that charges a lot higher fees, right? Like if you are uh, let's say managing $1 billion, and if you're paying 1 or 2% fees on that $1 billion just for transactional purposes, that's a huge chunk of money out of your balance sheet, right? So yeah, the priorities are different, the problems are different. That's why the solutions are going to be different as well. So this neobank and the stablecoin matrimony is not actually something, not a conceptual, not something that is that people are just thinking about theoretically. It already exists. Stable coins are already being offered by different neobanking platforms in different regions. Like for example, Revolut, which is basically a hybrid model that combines traditional banking services, and they also offer comprehensive crypto features. They support USDC, USDT across multiple blockchain networks, and then you have got Zappo Bank, which is I think a bank out of Gibraltar, and they offer very similar services. Stables, for example, they market themselves as a crypto account replacing your bank, and they have partnered with Visa to issue debit cards, and then you have got Plasma. Plasma is like one of the hottest stablecoin projects right now, and they have literally branded themselves as a stablecoin native neobank. Their initial focus is completely on USDT, and their strategy is basically attracting users through superior financial incentives. Basically, meaning like you are paying them high yields, like 10%, 10% yield, and up to 4% cashback on purchases, etc., etc. So
I mean, so when you look at these new banks like Revolut, they're mixing fiat and crypto in just one app. Do you think this all-in-one hub model will be the future, or will users prefer separate apps, maybe for trust reasons?
I mean, so the reason you say right now that all in is because you see crypto and fiat as two different versions of money, right? You see crypto as
Mhm.
the less trusted version. You put
Right.
stable coins in the same bunch as other crypto assets, right? So now that's because it's either number one, it's new, and number two, there are so much negativity and negative connotations associated with crypto, right? But very soon, and I will go more in details about this in the later sections of this episode, but very soon we are going to see the two difference melt away, like basically evaporate. You won't be able to say, okay, that's dollar and that's stable coin. The both things will be synonymous to just as money, right? And then the question that can you trust this, that question
Right.
becomes completely irrelevant, because money is going to be money. That's not crypto and that's not dollar. Both of them are the same thing, right? That's the goal right now. But that's the goal in the long term. But right now, obviously, you are going to use stable coins. If you want to use stable coins specifically, you're going to use neobanks just for fiat purposes. If you do that as well, right, until like something goes wrong, either bad publicity or some sort of of, let's say, scam, or something catastrophic in the market that happens, I don't see the trust factor coming into play at all here. um, since you asked that question, let me go directly into the abstraction side of the argument, because I believe this is one of the biggest obstacles that we are facing right now in crypto, is that we can't really convince anyone who is not crypto native to come into crypto and use them for like anything else, not speculative, not gambling, not trading. Like I want you to use crypto because it solves one of your day-to-day problems, right? And I know that crypto really solves very few actual problems, but thankfully stablecoin is a space that uh, that can solve any number of problems you're facing in terms of international transactions or payments in
Hmm.
general. Stablecoin can reliably solve it, but again, it's going to be quite difficult for me to onboard someone to use one of the most trusted stable coins, for example, USDT or USDC, which is much faster, much cheaper, much more uh, just convenient to use, right? But it's whenever you encounter the actual experience of using USDC or USDT, you have to create a wallet. You have to store the seed phrases securely. Then you have to basically understand which blockchain your money is in. Then you have to get the gas fees in, and it's just a complete quagmire of a system here that's basically scares people away. The Even if you're using like a centralized exchange, it's somewhat simpler, but it's still not that simple to use, right? That requires us to basically do a bunch of like really good job to abstract away these layers and these complications. One of the primary issue, as I see it, is like key management. For example, like you have a neobank or something like a wallet as a service provider, who like you can call it WAS, I guess. And now these service providers, they what they do is they will store your private keys, and they would offer you like institutional grade technologies like multi-party computation or MPC to eliminate single points of failure. That's I
Hmm.
believe I am a crypto native guy. I do believe in the believe that not your keys, not your coin. But at the same time, I know that how difficult it is to actually reliably secure your personal keys. That I don't know how much, like let's say you have thousands of dollars in savings and all of it is stable coin. And so if you lose that key, you essentially lose access. Like you completely
Right.
access to all of your savings. And that's simply not a responsibility that the majority of people want to take. That's just too dangerous and too reckless to do, even too reckless to do, right? And even if you don't lose it, like somehow it gets leaked, your laptop gets hacked or something or other happens, and someone else gets access to it, and your money is gone within seconds. So that's something I do believe that some sort of a centralized key management system will be extremely helpful to the average person. And when I say the average person, I probably am also going to be using some sort of platform like that, because it's just so easy to do, right?
Mhm.
uh, and that's one part of the of the obstacle. And then you have like gas fees and chain choices. There's like how much gas you want to pay, or like how do you pay the gas, and what chain do you do the transaction on. What I want to see and what is already in development by different projects essentially is that the infrastructure provider, they route the transaction across, like they choose the most effective and the most efficient network, be it Ethereum, Solana, or any layer 2 solution, without asking for any input from the user. As an user, I just basically say I want to send money to this address, and they figure out like
Right.
all the steps in the middle. Any transaction costs are presented as a simple fixed fee, Like just you pay fee for any transactions. So this is just one of those fees, and it has to be some sort of fixed fees. You cannot have it fluctuating, because the network is busy or something like that. And then the third and another like really crucial obstacle that we need to fix to deal with this abstraction issue is the on fiat on ramp and off ramp. Like for example, like there are providers like Cybrid, Crossmint, Lightspark. They offer APIs that allow users to fund their stablecoin balance using something like a bank transfer or some or credit card, debit card, or when you are selling it, it goes directly to your crypto is converted into fiat, and it goes directly into your PayPal or Venmo or something like that. So this is a crucial problem that if we can solve it, because I'll actually give you an example. In my mind, this is the perfect example, which is Polymarket. Are you familiar with Polymarket?
No, give me some
Okay,
context.
so Poly market is basically a prediction market. Think of a betting market, a betting platform, but you can actually bet on real life events. Like for example, will Trump announce a new tariff on this
Nice.
tomorrow? Right, and you can bet on it. And this is right now one of the biggest gambling platform in the world, and they are crypto native. It's built on top of a blockchain. But if you, as a regular user, you want to log into Polymarket, you won't feel that there is any elements of crypto to it. You can log in with your email address. They once you are logged in, they will pop up in a wallet for you by themselves. You can fill out. You can basically put money in it using any bank or any credit card or a PayPal or anything like that, and you have got the money. Now if you are a crypto native, you can obviously use the crypto features, but if you're not, they say tell you not to worry. You can use all of the familiar features that you already know and you already regularly use. And like I think New York Stock, the company that owns New York Stock Exchange, they invested $200 billion in Polymarket a couple last week. So this shows you that crypto platforms are more than capable of integrating with the real world without without taking any of the crypto complexity with it to the user. All you have to do is just figure out how to do it, and
Right.
will to solve a problem, and that's pretty much it, right? One more reason that I believe that neobanks and stablecoins can be a formidable ally is on the yield curve side of the argument. Like for example, like stablecoin based financial products, they can consistently offer you APYs, significant APYs than what your traditional banks can offer, and in some cases like even higher than what you can get from money market funds or some sort of treasury bonds as well. Like the yield gap is such a powerful economic incentive for you to use a neo stablecoin neobank instead of going to your own bank. If you can eliminate the complexity of interacting with crypto and blockchain and this entire technology, then people are going to be much more comfortable using these neobanks, and they won't even understand the difference between what is a crypto asset and what is not a crypto asset, right? And it's basically, think of it as like a sleeping agent or like a Trojan horse.
Mhm.
People are using, they don't expect to be using crypto assets. They don't expect to use stable coins. They have just, like, the average user have just downloaded the neobank because this is the banking infrastructure that they use, and all of a sudden, without having any idea that they are interacting with crypto assets, they are doing so. Like they are sending dollars from one country to another, and they think that like, I mean, obviously I'm not saying that the users are foolish or something, but I'm just
Right.
saying that they don't need to know that what kind of dollar what kind of like the dollar, or what kind of asset they're interacting with. Yeah, that's where the partnership with new banks and stablecoins, like the integration of these two entities is so strong. Uh, Another point that I think is, like, traditional banks lose miserably is on the APY section. Uh, Stablecoins can offer such high APYs, like an order of magnitude higher than what traditional banks can offer. Uh, or even in some cases like money market funds, and the yield that they offer. This is the gap is such a powerful economic motivator in this context, right? Because why wouldn't you go for a higher yield if someone offers it to you? Because you're the the yield that you are getting from your own sort of savings account is negligible, right? Yeah.
Right, and like I've also seen like stablecoin offering yields of like 5 to 12%, which are like significantly higher than the average bank yields. Now, do you think this premium is sustainable, or will it collapse as more capital flows in?
So the question is, where are these yields coming from? Oh, there are a few categories, as I mentioned at the very beginning. Like you have got the lending borrowing rates. I'm coming to that in a moment. But what is the biggest
Hmm.
source of revenue for these stablecoin issuers, which is the reserve assets they have in short-term U.S. Treasury bills and repo agreements, right? Like for example, Tether, they reported profits of about $4.52 billion in Q1 2024. Now that is pretty much all of it is coming from treasury holdings. So that's where and money market tokenized money market funds are also getting a similar amount of return on the T-bills that they are holding and the repo and the commercial papers that they are holding, right? Now, what about in terms of on-chain lending demand? So, like yields on DeFi protocols, like for example, Alpha, Compound, Morpho, they are generated from the interest paid by the borrowers. Like these are typically you're looking at over collateralized loans where users will borrow stablecoins against more volatile assets, for example, ETH or BTC, to gain they will do leverage trading, and the interest rate is determined based on the pool's utilization rate. The higher the demand for borrowing relative to the supply of deposits, the higher the interest rate that they charge the borrowers, and then they pay out to the lenders as well. So this is basically a pure credit market. Yield is a direct function of market demand and for liquidity. Now, if the market demand and liquidity goes down, your yield goes down as well. So, is it sustainable over a long time? Of course not. There will be peaks and troughs. When demand goes up, yield will go up. When demand goes down, yields go down. But very similarly, for example, if the U.S. government, if the Fed lowers interest rate, the USDC, USDT, the issuing companies of these stablecoins will also take a hit on their profit, and it will also affect their ability to issue you higher yields. Um, so yeah, that's basically where your yield is coming from. In general, if someone says that I can give you like 15%, 20% APY, just like these are the use our stable coins, most likely than not, like if it looks too good to be true, it most likely is, right? So I will be comfortable with yield amount anywhere from 4% to 6%. And even you are, say, managing a large amount of stablecoin holdings, like 2-3% sounds also pretty good in a market where interest rates are, let's say, 1 to 2%, which is obviously not the case right now. But yeah, 2 to 3% will be pretty interesting. The last category where I think like a stablecoin neobank combination will really shine is in terms of, like, you have got the custom stablecoins. Every single company gets their own stablecoin kind of a situation. Obviously, that will be too complicated to get, but you can
Hmm.
definitely get to a situation where you can issue your own stablecoins and program it in such a way that it behaves differently. Like different stable coins from different company will behave differently. And why does that matter? Okay, so let me just give you an understanding of what I'm talking about. Like, for example, like Stripe's open issuance. Well, that's a platform that they have created since they acquired Bridge. And what open issuance does is they are basically a service that enables businesses to launch and manage a custom stablecoin with just a few lines of code. So what they will do is they will handle the entire backend, including, for example, reserve management with institutional partners like BlackRock, Fidelity, liquidity provisioning, compliance, pretty much basically everything. They allow the brand to customize even the reserve asset mix and generate rewards for originating stablecoins on their platform. Now, what they're doing here is there's this concept of every single company having their own stable coins. Like, you have got your Amazon coin and Meta coin and Netflix coin.
Hmm.
After to an extent, it sounds interesting, but after a point, it becomes almost funny, right? Because, like, if you have 100 different stable coins circulating in the market, it's just confusing, and it creates more problems than it solves. But in some cases, like for example, traditional loyalty programs such as like airline miles, hotel points. They operate as a closed loop liability system on a company's balance sheet. It's inflexible, illiquid, and they expire, right? Like for if you have miles with one airline or another, you can only spend it with that specific airline, and you can only use it in like, for example, international trips to France, and that's why you can
Right.
use let's say Qatar Airway airline miles. So these are they that is essentially money, but it's a type of money that's very restrictive in its use case, and it you can only spend it under one umbrella.
So
Uh,
does it make them more useful or just more confusing?
yeah, so that's what I want to see. Like, to a certain extent, it definitely sounds more useful. Like, if I can
Hmm.
convert my Starbucks points with say, like,
Right.
let's assume Netflix has some sort of a points program, and if I convert my stable like Starbucks points into some my Netflix points, we have found some sort of an interoperability factor here, and we can definitely just bridge the gap. But
But I think
I,
also we need to see how the other companies will incentivize, because that's
yeah,
Starbucks won't like their own sales to go to Netflix.
yeah, exactly. So this is like a to be declared, like to be answered kind of situation here, where we don't know what it can do, but we can definitely speculate in some ways that can definitely open up a lot of doors, especially like if two different companies want to partner
Right.
on the loyalty points. Like that's definitely possible. And imagine on this actually on this custom stablecoins point, one thing that I forgot to mention is, like, you can definitely have a stablecoin right now. USDC, USDT, they all behave in the same way, but what if I issue a stablecoin tomorrow that I have programmed to offer you some amount of yield, and in some
Mhm.
platforms they will give you some specific, like, the special services, like, okay, you hold this stablecoin here, that means you are eligible for these services in this specific trading environment, and etc etc. And we have got different Ethereum like EIB proposals in place right now that are discussing programmable stable coins, or even like in cases of compliance, right? For example, USDT is creating a stablecoin specifically for the US market. Now, if you're using the stablecoin inside the US, it works completely fine. No, actually, like on the others on like on the other part of the on the of the conversation, let's say the normal USDT is not US Genius compliant, right? So you bring that USDT in the US and you try to spend it with a company, it rejects it directly. But if you use the USD like US version of the USDT, it works. So there are different optionalities here, and we can definitely take a look and understand, try out different ways to see what kind of custom stablecoins work and what don't. Um, but yeah, like these 4 points, these are the four things that I am really bullish on. Like I do really see how neobanks and stablecoins actually integrate with each other, and how they can make the overall system a much better and much more formidable banking infrastructure than what we have in the traditional side. So you have got like, so the four things I have said so far is that neobanks will be the delivery slash distribution mechanism for stablecoins. Neobanks will abstract away the feeling that you are interacting with a blockchain. Neobank API will trump bank yields by a lot, and without the requirement of locking in your money. And then custom stablecoins will be a game changer. Like every platform will be able to offer different built-in rewards to users, which has its use cases, right? Now, I also have a couple of concerns that I want to address. Uh, Obviously, it's not all rainbows and sunshines, is it?
Mm.
Uh, Now, with as I said, like with 100 different stable coins and without a golden standard, it will be at best it's confusing. You don't need 100 different stable coins to do 100 different things. Just that just creates its own problem. Like that's the best case scenario. And at worst, you breed predatory and unethical practices. If you have 100 different stable coins, there is no guarantee that 100 of them will be by the running the program by the book. None of them are cutting any corners. None of them are mismanaging their reserves. None of them are offering you like insanely high yields, like 100% yield in 6 months or something like that. And and if one of them falters or a few of them falters, that destroys the reputation of the entire stablecoin space, and that's where the trust issue comes in. Like, do I want to use this stablecoin neobank because I saw that that other neobank was doing something and they got caught, or they got busted, right? So where the trust issue comes in. And my other concern is that with the proliferation of stablecoins in banking, it will it will soak up a lot of liquidity from the market, and it will affect the bank's ability to create credit through the fractionalized reserve banking system. Now, this is actually a core concern that the policymakers are also facing. They are also actively discussing it. The Fed actually recently, actually not recently, maybe in the last couple of months, they published this report where they discussed the possibility, and they discussed two distinct possibilities. One is a two-tiered model. Now, in this scenario, what a stablecoin issuer will do is they will hold their reserves as large corporate deposits within the commercial banking system. So when a consumer moves $100 from their personal savings account into a neobank stablecoin product, the $100 simply moves from their personal account to the bank's commercial, like to the stablecoin issuer's account at the same commercial bank. Now, the fund never leaves the banking system. That basically enables the bank to create credit out of that same deposit, and the fractional reserves banking system works seamlessly without any interruptions. But the problem happens when the stablecoin issuers, with their 100% token backed assets, they keep that in a central bank reserve and not at a commercial bank. Now, in that case, if a user withdraws $100 from their account and converts it into this neobank stablecoin, what happens is the commercial bank loses out on that $100, and it goes directly to the central bank, which is outside of the commercial banking ecosystem. That means like it's losing out on deposits, and if it's losing out on deposits, that means it cannot create credit in the same rate that it was doing before, right? And the more the liquidity goes away from the commercial banks to central banks, the the more stark the problem becomes, that credit is evaporating out of the fractional reserve banking system. And that's where we really hit a wall that can disrupt the basically conventional economy as we know it. Now, obviously, we are going to come up with some sort of a solution, but I don't like the two-tier model is going to work in my opinion. The banks are going to figure out some ways, and the regulators will also come in to save the banks, as they have always done. And we are going to find this harmonious existence where stablecoins and these banks exist together, up until the point where the banks and the stablecoin neobanks find a way to merge, and the overall system becomes much more efficient. Now, that's like foreshadowing 10-20 years maybe. I don't want to know that much ahead, but so far, like the whole neobank and stablecoin thing, I am like exceptionally bullish. I think this is the right way to take this, and yeah, we'll see what happens.